Hello everyone, it's their finale with RMI LLP. I hope you're having a fantastic week. Today I wanted to touch on a topic that's been coming up more as people get ready for tax time here, and that is investments taxation through a corporation. So this is a very interesting topic and I can chat for hours on it, but I'll keep it simple and high level for now. So a question I get very often is, if I do investments through my corporation, what does the tax look like? Is it better or worse than personal taxes? And the answer is, well, it depends again on how you look at the overall situation. So first and foremost, when you invest corporate money into passive investments, the tax is a little bit different than your normal regular tax rates in a corporation. What happens is companies will pay a high tax up front, and then over time, when they do dividends and take that income personally, the company actually gets a refund on the extra tax that it's paid. The idea behind this is that tax integration. So CRA has come back and said, whether you're in investments personally or through your corporation, the tax on it should be very similar. The tax on small business is lower because you're building the economy and helping improve the economy on that standpoint. But when it comes to investments, because they're passive in nature, you get taxed at a higher rate up front. And then when you take that income personally, you pay the high tax on the personal side, so the company gets a refund. So you don't end up in a position where you're paying too extra tax by any means, but there is one thing that becomes important here, and that's called your capital dividend account. So what is a capital dividend account? Well, in certain instances, when a corporation earns income, for instance, a life insurance policy in a corporation and the individual dies, that's one example. Or when you have capital gains, that's another example. When you have capital gains in a corporation, half of the gain gets taxed as normal, that many people are familiar with, but the other half goes into this account called CDA, or capital dividend account. So similar to life insurance proceeds, the capital dividend can actually be withdrawn tax-free from a corporation. So there's a big advantage here because you can use corporate dollars that are at low tax, invest that for a capital gain, and when you have that gain, you end up being able to pull half of that money out tax-free. So there still is a small advantage when you're able to invest through a corporate structure. As always, this is a very complicating topic, so feel free to reach out. We're always here to help, and if there's any questions, please reach out. Thank you.